All right, are we going to rally back to all-time highs? Are the bulls buying that dip once again? Hi, I'm Ryan Mallory, and welcome to my channel where we talk about the stock market, swing trading, and how to be successful traders in the stock market using technical analysis and 30 years of trading experience of my own. Make sure to like and subscribe to this channel here so you can get notified of all future updates, and make sure to click that join button down below so you can get all of my market research and updates on the regular of S&P 500, NASDAQ 100, Russell 2000, plus weekly watch lists and my daily setups of stocks that I'm looking to buy each and every day, plus the most intriguing charts that I come across. Check that out. Pound that join button below. All-time highs. Is it feasible? Yes, I actually think that it is feasible. I mean, despite the huge sell-off this past week with the Evergrande real estate conglomerate starting to blow up, the S&P 500 shook it off after one significant day of selling. The S&P 500 finished 0.5% higher. The NASDAQ 100 finished 0.1% lower, but the NASDAQ composite finished 0.4% higher. What does that tell you? It tells you that the FANG stocks and big tech stocks were really lagging the overall price action, while small caps finished 0.25% higher. But what was significant about that is on Monday, the Russell 2000 was actually down as much as 4%. And yet it still managed to finish the week in the green. Your best sectors were energy and financials, while the worst was the materials and utilities. Also, let's not forget technology. Even though big tech lagged, the rest of the tech sector did fairly well. With the FOMC this past Wednesday, the Fed is talking about tapering before the end of the year, and it's also talking about raising interest rates as early as the middle of next year in 2022, which is a change from what we were expecting, which would have been 2023, or not even talking about or thinking about raising interest rates. So it's getting a little bit more hawkish on the Fed side, but Jay Powell and the Federal Reserve is making it abundantly clear what their intentions are and giving quite a bit of advance notice so it doesn't shake up the market like it did in 2018 when they started raising interest rates and the market had their taper tantrum that sent the stock market lower over the course of the next 3 months. Now, let's dig into the SPY chart, because what I want us to look at here is how this chart has a nice hammer candle this past week. We tested that 20-week moving average. It held, and what was cool is that we've tested it plenty of times before and held as well. You have a test here back in March of this year, you have another one back in late October of November of this year, and you had another one in late September of last year. So the main theme is that this 20-week moving average continues to hold strong for the market. Yes, we closed lower back in October, but it also jump-started an incredible rally from November that has persisted until the current day. Now you got to remember, these hammer candles are pretty bullish. And what I mean by that is that it actually attempted to push lower, but the dip buyers jumped in and pushed it back up to where it started the week off at. That shows that the bears did not have enough to keep the price lower, and the bulls instead won the day by bringing it back above where it started the week at. Now on the monthly chart, it's also very bullish still. You have this 5-month moving average. Price is not broken below it yet, and instead it continues to rally off of it each and every time. So 5-month moving average on the monthly that you want to watch. The 20-week moving average on the weekly chart. What about the daily? Now, what about the daily? The daily is a little bit different here. It doesn't paint as rosy of a picture. You have this 50-day moving average that has been so solid for the market for all of 2021. You've seen where it's bounced in January, again in March, twice in March in fact. And then it got May, and you got June, and you got July, and you got August. But then in September, we gapped below it. We were testing it, and then the last Monday, we gapped below it, which is something that we haven't seen yet. And then it followed through just by a small margin the following day. And then the next 3 days, it broke back higher and back above the 50-day moving average. And that's good. That's a good thing. But going forward, I'm not going to trust this 50-day moving average to provide support, because we had such a huge violation right here that it's lost its credibility. Going from the bullish standpoint still, we need to look at this declining trend line here off of the all-time highs. You can see here where the declining trend line is being tested on Monday. We need to break back above that and hold that price level, because so far this has been a consistent source of rejection for all of September. So if we can break above it, I think that's a good sign going forward, and it sets the stage for a retest of all-time highs. And if you look down here too, you have the RSI with a nice crossover to the upside. You have the MACD on the verge of one, and then you have the stochastics rallying off of oversold conditions. So all three of those are painting a fairly good picture as well. Now here's another word of caution here. There is a head and shoulders pattern that's forming. Now for those who don't know what a head and shoulders pattern is, it's basically a silhouette of a human being. you have a left shoulder, a head, and a right shoulder. So what we have here is almost a complete head and shoulders pattern. You have the left shoulder forming right here, you have the head here, and a potential right shoulder right there. Now the neckline comes in right about here. You have a solid support level that was violated with that sell-off on Monday, but so far has managed to hold. You can see it rallied right back up in the final hour of trading and held that neckline. If it breaks below the neckline, it gets a little bit more bearish, but where the head and shoulders pattern has lost so much credibility over the last year in particular, and even in general over the last 10 years, is that you see a lot of bounces off of this neckline. You see it just right here happening. Now, does it form that right shoulder and then come back down and retest it? I'm not sure yet. And that's why this declining trend line is so important for it to break through this coming week. But what you want to watch for is if we test this neckline again and break below it, then you need a follow through. And even then, you just maybe build up a position over time, because these head and shoulders patterns have been very fickly. It doesn't mean that they don't ever confirm, they do, but it's been very difficult to sustain a head and shoulders pattern because of this constant intervention by the Federal Reserve and the equity markets. Now check out the VIX, because this has been pretty interesting. Here you have two declining trend lines that are in play here, and one's more extreme in terms of movement that it takes to test the higher declining trend line versus the lower one. The lower one, it's more minor moves that constantly test it and get sold off. But then you get these big shock events, like what we saw back in February and what we saw back in late October during all that selling. And that's what we did. We tested it, but it couldn't break through and hold it into the close. Instead, we saw it come right back down and close right on it. And then the next 4 days saw some extreme selling on the VIX. That is a pattern that continues to persist. I wouldn't be surprised if we saw volatility drop as low as 16 or 15 this week. Now check out the T2107. This is the percentage of stocks that are trading above their 200-day moving average. Man, this isn't a good look at all. And what I am continuing to see in the market is less and less stocks that are participating in this rally, and more reliance on the FANG stocks like Facebook, Apple, Amazon, Netflix, Google, Microsoft, and Tesla to keep the market going higher. And you could throw Nvidia in there as well. I guess you could probably even substitute Netflix at this point for Nvidia. But nonetheless, you have this constant trickle lower where less and less stocks are participating. The S&P 500 is way above the 200-day moving average. Yet the T2107 has 55% of stocks trading below their 200-day moving average. That's not a good sign for the market. It's, like I said, it's very, very reliant on all of the FANG stocks to keep this market going higher. And because of their huge market cap, it's able to do that. And you got this trend line that shows that it's starting to accelerate even more so to the downside. You had this trend line that prevailed for much of this past year, and then since June, since the summer doldrums kicked in, it has just gotten worse and worse and worse, and it's accelerated to the downside with new lower lows and lower highs. So I've laid out a lot of good and a lot of bad about this market right now. Yes, I still think that we probably go up to all-time highs as long as the Fed doesn't throw any big surprises out there. And then once the tapering starts to take effect and they start raising interest rates, that's where you're going to see the real problems start to wreak havoc in the market. But until then, the Fed is still providing a lot of wind to the market sales. So let me know down in the comments below, what is your plans for this coming week? What are you looking to buy in? Are you bearish on the market? If so, what are you shorting? I want to hear all about that, and make sure to click on that join button, make sure to like, make sure to subscribe, and God bless you all.